Hey everyone, it's Paul with Investment Tuesday. So welcome to Investment Tuesday. We got a packed Investment Tuesday today, and we're going to cover three things. All right. First, I tell you why I know that the S&P 500 is making all-time highs. I know that the Nasdaq 100 is making all-time highs. I know that there is a lot of happiness. There's a lot of joy in Investmentville. I made that up. Yeah. I mean, I'm in the investment world. But as I have been saying for about a month, 4 or 5 weeks or so, the background music to these all-time highs is it's not what you want to hear. Still, I'm going to tell you what I'm finding. It isn't my job to agree with you and to confirm your thinking. My job, at least the way I see it, is to present the best information that I can find, give you my interpretation, my opinion of it, and you choose to do whatever you want with it. You can think like, hey, this guy is a fool. He's losing me money. I could be making, you choose whatever it is. Nonetheless, I can say this. I've been around a long time. I've been in this game for 30 years. I got scars. I got losses. I got victories. I got it all to show for it. So you can, take what you want, send it through one ear, out the other, use it if you can. But I'm going to very quickly go through why, like I said, these all-time highs and the excitement and that dreaded word, the euphoria that goes with it. Yeah, I hate to say it, but not a good sign. Not a good sign. Not a good sign. And I'm going to show you why. And tell you like what the underlying reason is for this, for the dissonance, right? In other words, like normally into all-time highs, I'm Mr. BOP, bullish, optimistic, positive. I'm like, let's go, LFG. But not this time. Why? I'm going to show you why. All right. And then I'm going to tell you like, well, because of what is driving the dissonance, I don't think like what's going to happen is like a 2008 style crash. It just doesn't feel that way. I think it's going to be like where, there's periods of volatility, certain sectors don't do well, certain groups of stocks get taken to the woodshed and cut down. And we've seen a little bit of that last week. I think and there's volatility where it moves up, moves down. So like I think people preparing for like a grand, enormous crash are going to be disappointed. I think instead it's going to be very much a stock pickers market, a strategist market. In other words, you got to have the right strategy, and with the right strategy, you can make a lot of money. All right. Let's quickly get through all the usual things I put up at this time, which is things that make our lawyers happy, which is that this video and the content from ATG Digital is not investment or financial advice. It's presented to you as opinion, information, engagement, and entertainment. Whatever you choose to do with it, remember, it's your responsibility because it is your money. Next, all ATG Digital content may contain errors, oversights, and mistakes. Just because we say it doesn't mean we're perfect and we have like some kind of omniscience. Understand that investment operations have significant risks, and that can lead to the loss of principal. Bottom line, you can lose money. All right. Next, the owners, employees, contractors of ATG Digital, we own, trade, transact the securities that are mentioned in this video and all the content from ATG Digital. We do not take money from company managements, crypto sponsors, etc., to recommend their stocks or crypto tokens. So for better and for worse, for gain and for loss, everything we present to you is our unique independent point of view. We publish quite a lot of content at ATG Digital. We publish my Substack, which goes out every market day. Any day the market is open, we have contributions from me, from Dean, from Dan. You know who they are from watching the channel. I have a podcast on Spotify, which puts out an episode about once or twice every month, focusing on macro, focusing on behavioral elements of finance. and things that we generally don't cover that much on the YouTube channel or even in ATG Digital paid content. Finally, I'm here on YouTube. I don't need to say more than that. Social media. I am quite active on X on a pretty regular basis. We are somewhat active on Instagram and Facebook. Follow us in all these three places. I almost always forget to do this. So let me actually get the YouTube channel up so I can show you how you can actually become a member of this channel. And what do you get for being a member? Well, you get early access to this video, which is, sometimes we do dish out ideas that move ahead of the video. This is not some manipulation on our part. This is just complete random luck. But nonetheless, if you think that that is something that you would like exclusive early access to, well, then what you would do is go, you see on the right-hand side there where, you know what, let me go to the tab. See here, the subscribe button, you click subscribe here and you hit join. And then for $9.99 a month, you join the YouTube channel and you get early exclusive access to our videos. The other thing that you can also do is join ATG Digital and get a subscription. You would go to atgdigital.media. That is where you can go get a subscription. We have various different tiers. Look through what is right for you. And the benefit of that is getting follow through on whether it be the macro stuff that we talk about, the market related stuff we talk about, or specific stocks, whether it be Fannie Mae, whether it be anything else. What have we done? Did we sell it? Did we buy it? Are we still recommending it? Well, this is where you would go for all of the above, and subscriptions there begin at $9.99. All right, let me get all of this off. All right, let me get down to it. All right, a lot of tab management that needs to happen. Okay, so I have said that the current market moves that are going on, which are very heavily focused really on a handful of names, right? I mean, and what they are. They are NVIDIA, they are Microsoft, they are I will not throw Tesla in there. They're Mag 6, if you will. It's Mag 7, you can throw in, Broadcom, I mean, it is some tech stock of some shape, form, or kind. This is what is driving, retail trader euphoria, right? I mean, and this is a euphoria index that is calculated by Barclays. By the way, this is from Lance Roberts, someone that, you can subscribe to yourself and read it. But this euphoria index is never a good thing. In other words, there are a lot of people with very high expectations who are paid very high prices, often with borrowed money, which is never something you really like to see. I mean, what you really want to see is, you want to see numbers like there or there, obviously, in other words, where people have sold all their stock out. And now, as it turns out that whatever fear, panic, problem, that they imagined was going to be the worst in the world, it's not as bad, prices recover. So there is enormous euphoria. I'll say mostly among retail traders. I believe that the price swings that we have seen, upward swings, we haven't really seen any downward swings. I think we've gone through like 6 weeks or something like that where prices have just been up. Is mostly driven by retail individual investors, right? I believe that some professional investors have joined in because they have to play the performance game. If you're a hedge fund and you don't keep up with the S&P 500, you don't keep up with the NASDAQ 100, your clients will terminate you. You'll lose clients. So they got to play the game. So I believe they're playing it to some extent. But nonetheless, the bulk of this move, the force behind this move, is very much a retail-oriented move. Now, Here's why, in my opinion, the accompanying music, if you will, to these moves has a major problem. And I've talked about this, which is um, has to do with the bond market, has to do with the amount of bonds that the United States government and actually all of the major governments around the world, the European Union, the Japanese, the Chinese governments, and they're all, massively in debt. They all are issuing vast amounts of debt, yet long-term bond yields really haven't responded to it. And there was something quite interesting that happened when we had a sudden shock, right? And that was when President Trump announced his Liberation Day tariff. So that was like, I think, April 6th or 7th. And the Liberation Day announcement was met, in the stock market with a thud, a crash, essentially. So you'll see here, the blue line is the S&P 500. I've kept this very simple to two different things. The blue line is the S&P 500. You can see, I think this is the announcement of the Liberation Day, and then, just essentially a 15% move down, more or less. And this red line is something called the MOVE index. The MOVE index is a volatility index associated with US Treasury government bonds. And this is where the surprise came. You see, normally into a stock market crash, which usually indicates what? Well, it indicates that there is going to be some kind of economic or financial crisis. There's going to be a recession, that there is essentially going to be economic weakness. Bond prices actually go up. They don't go down. This red line going up is not a good thing. It's a bad thing. It means that something unusual happened, which is that bond prices actually fell. In other words, bond traders, and we're talking about US Treasury bonds, which are the most desired bonds in the world. The reason for that is that the US government issues its own currency. It's never going to default. We also have a substantial economy. We've got, markets. We've got, we're a real country that has rule of law, all these different things. But the one risk that's remaining in US Treasury government bonds is inflation. So it was a shocker when the S&P 500 fell, stocks in general fell, and bond prices also fell, meaning that interest rates went up. And what's going on here? Like, why is this, an issue for the stock market? And why is this an issue if you are one of the folks that is euphoric somewhere here? We are here. We have had a straight line recovery back up, right? I mean, we had the crash, the Liberation Day crash. Bond yields, long-term bond yields blew out. By blew out, meaning that they jumped to levels that nobody was expecting, nobody was anticipating, because if you're going to assume that there is going to be a tariff-led recession, a tariff-led slowdown, a tariff-led any problem, it would mean there's economic weakness. It would mean that you could expect the Federal Reserve to lower interest rates, which would increase liquidity. However, instead, what we saw is interest rates. We're talking for the 30-year bond, for the 10-year bond, 7-year bond, essentially anything that's long term. Yeah, I mean, those interest rates actually went up. They went up. And that was a shock. That was a shock. All right, people were not expecting. I'll get into why there is now this dissonance, this variance between the stock market and the bond market, which, as stock prices have gone higher and higher, there's this gap between the expectations of what the stock market and the bond market, what they are seeing, especially for long-term interest rates. That's got to be reconciled, all right? It's got to be reconciled. It's got to be resolved. It doesn't have to be necessarily resolved tomorrow. Maybe it resolves over 10 years. I doubt it. It doesn't have to resolve in one shot, which would mean everything happens all at once. Given that we already had a Liberation Day crash, etc., I don't think like that's maybe the highest likelihood, but it does have to resolve in some way. And these euphoric levels of stock market, here, look at it in this way. I mean, this is a chart of all the major indices in that trade in the United States. Just want to make sure that everyone can see this. It's a very busy chart. So I'll essentially, again, you see the Liberation Day crash here. That's the crash and this recovery, right? S&P 500, NASDAQ 100, NASDAQ Composite, Russell 2000. I mean, the small caps have underperformed as they have for the better part of 5 years. It's pretty much been, the big tech dominated indices. That's what, keeps getting bid up, keep getting bought up. And the other reasons for the dissonance, for the sour note, to accompanying these new highs beyond, again, this rumblings that is going on in the bond market, right? I mean, 30-year bond yields keep, testing that 5%, even though, there's pressure on the Federal Reserve to cut short-term interest rates. The 30-year bond and the 10-year bond are wanting to go the other way. They're wanting to push rates higher. So this is, I think, much better understood by professional investors who have been around, that understand the financial logical connections between interest rates, especially long-term interest rates, to valuations for stocks and risk assets. And I think that these things are much less understood or poorly understood by many retail and individual investors. And this is why I think you're starting to see this kind of the current stock market highs are really quite thin. What do I mean by thin? In other words, there's far fewer stocks that would be participating than when you'd normally making all-time highs. So this is a chart of the NASDAQ stock market. In case you don't know, there are two stock markets in the United States. One is the NASDAQ, one is the New York Stock Exchange. And stocks trade on one or the other. They don't trade on both. They either trade on one or the other. Right? So this is the NASDAQ, and you can see the number of new highs, right? And people might be thinking, well, Paul, what does the new highs matter? Well, it tells you people's confidence. It tells you people's conviction. And if you see a lot of stocks making new highs, it tells you that people are seeing that a lot of companies are going to benefit from the current financial and economic environment, whatever it might be. It might be that interest rates, might be earnings, might be a lack of inflation, whatever it is. And they would be bidding up a lot of stocks. Instead, really what we have seen after, the Liberation Day crash, that's this big mass of red where, the number of new highs just crash down to nothing. Less than nothing. It's actually been a very few stocks that are participating in this. So in other words, while the stock market's making new highs, it's actually a tiny, tiny number of stocks that are really pushing this higher. In other words, the S&P 500 is getting increasingly concentrated into NVIDIA, into Microsoft, into Broadcom, into all of these stocks that are very popular, that people believe, thematically, it's like AI is going to, cause, an instant boom and prosperity. There are stories that are going along with it. People are just buying these things irrespective of financial conditions, economic conditions, or even necessarily any understanding of economic or financial history. So it's a very thin advance. That's the jargon that people would use when I was working on Wall Street and managing money. They'll say this is a thin advance because very few stocks are participating. Let's look at the other exchange, which is the New York Stock Exchange, the number of highs and lows, and you see the same thing. Liberation Day crash, where a number of new highs is nothing, is zero. Instead you have new lows, 1,161 new lows. And then the recovery, very few new highs, like, 182, essentially, 100 to 200. Once again, a very thin advance. So that is not what you would normally see into a market where it's robust. It's driven by a lot of genuine optimism about earnings, about the underlying financial conditions. Yeah, that's a tell that there's just not as much participation as before. So I was telling you, like, the reasons for, I believe this. In other words, if professional investors, who control, the vast majority of the world's assets, if they were buying in a big way, you definitely see a lot more participation. Like, like you can see earlier on in August and September, etc. You just got, way more stocks that are participating. And in a truly bull market, you'd have, 200-300 stocks, or even 800 stocks like a day making new highs. Why? Because the financial and economic environment is good for so many companies, which is then translated into investor enthusiasm for those stocks. So I told you that the issue really comes down to the bond market and the stock market having divergent views. The stock market thinks that short-term interest rates are good. It thinks that inflation is under control, and that if we can get short-term interest rates down, we've got this massive, massive innovation tailwind of AI, which can, essentially solve all economic problems, and we should just keep going higher, right? That's the general stock market view. The bond market, and this is a chart starting from 1979. I'm going to shorten this chart up to make it more impactful for now. It shows you, like, these are interest rates over, from 1979. So like 46 years. And you may be thinking, well, what does that have to do with anything? Well, if you have been in financial markets long enough, number one, you know that interest rates are cyclical. There are long cycles. These go in like decades, don't go in years. And they have a different logic than stock markets. And the folks who buy bonds are generally concerned about, people who buy US government bonds are only concerned about one thing: inflation. If you buy corporate bonds, you would be worried about default risk as well. But essentially, you'd worry about, what we're talking about is US Treasury government bonds. People are only concerned about one thing, which is inflation. So if I just go and do a little analysis here, you'll see, I remember I told you that interest rates are cyclical. You'll see that, prior to the global financial crisis in 2006, early 2007, rates are about where we are again. In other words, interest rates, after going through a period, after the global financial crisis and Lehman Brothers and the meltdowns, in stock markets, real estate markets, everything, we've gone through a period when interest rates were very low, right? At 1%, 0%. There were actually periods when interest rates were negative. We're now back to where we were pre-global financial crisis. If you go and track this back, we're actually back to levels that we have seen through the 1990s at various times. Current interest rates would, where there have been periods in the 1990s. You're in 1998 or so, we had rates that are there. Those were periods which were, those are just normal sort of like times. So you might be thinking, well, if those are normal, what's the big deal, right? Why are you going on week after week being such a party pooper? Just get on the train, be bullish, be optimistic, be positive. I am. I'm a BOP on my analysis. Why? Why bring all this up? Well, because one of the things that, I want to do is bring, information that is actually useful, because I think retail individual investors, I think, generally are very price focused. They're not particularly analytical. I think their understanding, particularly of macro, is rudimentary, and they think it's not important until after something happens. When after it happens, you're like, oh, I wish I knew. I would have sold. I would have raised some cash. I would have, I coulda, woulda, shoulda. So hey, I'm going to bring this information to you, and like I said, you can choose to do something, nothing, anything with it as you will. But what has changed between the last time we saw interest rates at this level, 2006, or, arguably, the late mid 1990s or so? Well, the big things that have changed are to do with what happened after the global financial crisis with the central bank and our governments and the accumulated effect of it, right? And what happened is that we had these enormous losses that the investment banks created by their, reckless behavior on the financial system. That to be paid back. And one of the ways that was paid back was, well, the Federal Reserve essentially issued money, right? I mean, rampantly issued money. And in various different ways, it essentially sent it to various parts of the financial system. But the total amount of money issued, at the eve of the global financial crisis was about 6 trillion, and we are now at 22 trillion. In other words, there's a lot more dollars out there than when, interest rates were at this level last, right? There's way more money out there, right? Not a small amount. We're like nearly 4x, right? That's a big deal. Next, at the eve of the global financial crisis, I mean, our deficits were almost laughably, they were quite modest, really. I mean, we had like a deficit of like 160 billion, but at its worst, we had a deficit of 3 trillion post-COVID, and we're now at what, 1.8 trillion. What's a deficit? Essentially, you think about your household budget, money comes in and money goes out. The difference is either positive or negative. If it's negative, it's a deficit. If it's positive, it's a surplus. The government essentially runs, a more complicated version of the same thing. In other words, we have been overspending money for a long time, but we really kicked it into overdrive post the global financial crisis. So, I mean, we used to modestly overspend, but this is all negative. In other words, we're blown out. Every credit line. We're spending like some people would say, drunken sailors. So you're looking at current interest rates, and you look at 2006, the financial condition of the government in terms of how it manages its spending, significantly worse. I mean, there's just no other way to put it. Significantly worse. And it's accumulated higher. I mean, every deficit, leads to debt. And if you're not able to pay it down at the end of the year, well, now it accumulates. And that's the total public debt, which is now up to $36 trillion, right? I mean, $36 trillion. Back in 2007, when interest rates were where we were, our debt was 8.8 trillion. We have like we have like 5x this almost. Bottom line, interest rates and the financial condition of all these things that would matter to long-term treasury bond investors. Yeah, I mean, they're in very different worlds. And my view is that given the amount of borrowing that the US government has to do, and then I'll add that in 2007, the European Union really didn't borrow a lot of money. Japan did, but they need even more money. And China didn't borrow much either. Now all of those governments need money. In other words, there's a lot of governments around the world that need money, that have some version of the same thing. They all have deficits. They've all, on some level, issuing money. They all have rising levels of debt. And yet interest rates don't really account for that, right? And this is the sour note. This is the dissonance. And this is why long-term bond investors are suspicious. They are not going along with the stock market with the idea that if short-term interest rates go down, that's a good thing. From their perspective, if short-term interest rates go down, it means more money issuance. It means that there is going to be greater inflation. And that has created, this scenario where normally into a scenario like a Liberation Day panic, where the markets panic, etc., people would normally rush to buy bonds. Instead, they rush to sell bonds. Why? Because they're like, well, into economic weakness, you're going to cut interest rates, you're going to create more money. It's going to create more inflation. Not good for me. Yeah, I want to be paid more. I want a higher interest rate. So that's the crux, if you will, of the issue. I try to summarize it here, which is that interest rates are back to where they were in 2006 or in various parts of the 1990s. However, money issuance has gone through the roof. Deficits have gone through the roof. The debt has gone through the roof. So that's why this MOVE index, what it did matters. Long-term bond investors are nervous and edgy about inflation. And they are showing signs that a move by the Federal Reserve, which is highly desired by President Trump, highly desired by stock investors, to cut rates is going to make them want even higher long-term rates. And remember, when interest rates go up, bond prices go down. So the stock market, though, is still acting and still believing that we're like in the old bull market and that lower short-term interest rates have no inflation effect, and they're keep pushing valuation levels of the popular stocks ever higher. This is a risk because when rates get cut, I don't know what exactly will trigger it. I've laid out one scenario where long-term rates get bid up, that because the Treasury cannot sell enough bonds. Or maybe even happens in, some other government bond, like for Japan, etc., which then has a ripple effect around the world. And then if it freezes bond markets, and we have junk bond markets, which are at all-time highs. We've got corporate, bond yields, which really haven't adjusted to all of this. And the Federal Reserve says, oh, hey, XYZ market is frozen. I need to cut rates. You're going to have a surprise and a shock, which is that long-term interest rates will go up. And when long-term interest rates go up, the value of companies are lower, not higher, right? Okay. And you need to understand like some, financial reasoning, which is that U.S. bond, government bond, long-term interest rates go up, for only one reason. It's inflation. I went through this because the government issues its own currency, and it's never going, given that it issues its own currency, it's never going to choose to default on its debt. So here's, the issue, in terms of how everything is constructed, right? The easiest way to think about inflation, forget all this fancy schmancy, like ways, like all this. Essentially, it means that future money is worth less than present money, right? That's it. Right? That's what inflation is. And if future money is worth less than current money, it's a problem for stock markets in general. Why? Because stock markets are based on future cash flows, right? That is the basis of every company's value, because the past is irrelevant, right? It is what is going to happen in the future. Then the future earnings of all companies are going to be worth less in the future. But it is a particular problem for the most popular stocks today, right? Which are growth stocks, which are very speculative stocks. Hey, I played in all of those when I was at Banyan Hill. Why? Well, because we had very low interest rates. We had, zero interest rates. And it looked like that was going to continue for a very, very long time. We also had no inflation. People worried about deflation. Completely different environment than what we are today. It's a huge problem for many of those stocks, not all, because some of those stocks will be able to outrun inflation, right? But not all of them. I mean, there's just generally too much competition in capital under capitalism. And also, given the amount of money that was issued in the last, like 15 years, that has been thrown at all these growth stocks, there's so much competition there. These stocks are the most bid up. They have the highest valuations. They're also widely owned by individual investors at generally very high prices relative to future earnings, relative to future sales. Because people are excited about AI. People are excited about, all these speculative companies. Some of them will work out, most will not. That is just market history. But it's all based on future growth prospects, where the overall picture, as per the bond market, is like, our view, the bond market's telling you, hey, our view is that, more money is going to be issued. That's bad for bonds. That's bad for future money. Means rising inflation. And so if you're a growth stock company, one of the things that, their value is based on, it's based on like your sales 7-10 years from now, because many of those companies have no sales, they have no profits, they have no potential really even for profits in the next 5 or 7 years. I mean, they're going to need support from their investors, etc. However, their peak sales in the future, if that's what, at all-time highs, people are definitely, saying, look, those peak sales, they're guaranteed to come. They're worth a lot. Well, those peak sales are actually worth less and less with each passing year under inflation. And as it currently stands, most growth stocks simply do not discount or anticipate this. And you may be thinking, well, why? Well, I can only think of one thing, which is that there is an extraordinary amount of optimism and enthusiasm for AI. And I believe on a technology basis, it's justified. Right? But however, there are no innovations that happen overnight. There are no innovations that cause like an economy-wide, worldwide boom instantly. There are always ups and downs, and they're always subject to all the usual things that cause problems for previous innovations. That would be true. I mean, I sat through the internet boom in the 1990s, and then we had, a brutal bear market that lasted, I mean, depending on when you want to measure, arguably till 2016. I mean, if you looked at, all the stocks that people love today, like Microsoft, I mean, nobody wanted to buy those for anything. Even in 2010 or 2011. I mean, that's true for NVIDIA. In other words, there are always cycles to all of this. Nonetheless, when something is new, it just comes. We are taken by the idea that this is going to happen right now. It's going to happen very fast. We don't want to miss out, right? And this, I believe, is the underpinnings for what's going on. Recency bias. In other words, well, I mean, a lot of people are simply looking back at the last 15 years and be like, well, Paul, if I had bought in 2008 and 2009, I'd be up, blah, 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 right? Yeah, except that, that was a different world. Prices were very low back then. People's expectations were very low back then. Valuations were very low back then, right? I mean, these are not, we're not in the same place. And finally, a lot of new investors came into the market in the last, I'll say 5 years. I know at COVID, I saw a stat from FINRA, which is the regulatory arm that manages markets, saying that 20% of investors had come in, of all investors had come in 2020. So I'm assuming it's like 30% now. So a lot of investors really don't have a lot of experience, don't have necessarily a good understanding of financial history, market cycles. They may think that this time is different. AI will make everything different again. And well, anyone that's been in markets long enough knows that that is just never true, right? I mean, the cycles are always there, and the cycles exist because we are human, and the cycles exist because in the end, the markets are a mirror of human psychology, human feelings, human emotions, human actions, which are, well, one day we're incredibly optimistic, the next day we're pessimistic, one day we're in between, and those are all reflected in prices. So when you have, a very steep rise, when there is, in my judgment, my opinion, a clear issue that needs to be answered, that is critical for markets, it's a time to be cautious. It's a time to be careful. It's a time to be thoughtful. Rather than, like normally at this period of time, I would be on here saying BOP, cheerlead this on. Not now. Like, hey, there's an issue here. I can see the reasoning for it. Maybe, nothing happens. Maybe, this just peters out. I don't think it's likely, just given the size of the debt, the size of the funding needs of the government, and the fact that, into a genuine panic about a real event, which is the tariffs. Remember, when President Trump issued his Liberation Day, tariffs were going to be 145%, right? I mean, so the stock markets are immediately pricing a major financial event, right? And into that, it's completely normal for stock prices to have crashed. That's completely normal. However, it is not normal relative to the last 15 years for bond prices to also have crashed and for bond yields to have gone up. In other words, people didn't chase the security, safety, and stability of government bonds. They went to sell. That is not a small thing. That's not a small thing. And I'd like to ignore it. I want to ignore it. I want to jump on the bandwagon and say, hey, keep the bar open. Let the happy hour continue. But I can't. I ought to present to you what I think is what I can see. And I might be wrong. I might be right. I'm still going to present it to you. Now, as I did say, I am not expecting a 2008 style crash. There is simply too much money in the system. And there are just so many different ways by which people are hedged in various different ways. So I think it's going to have some other shape. I mean, I'm sure there will be volatility. There will be instability. There will be things that surprise and shock people. But I don't think it's going to look like 2008. I think like the vast majority of people have hedges. They have for like if something like that happened that quickly, they're hedged out for things like that. So it's going to take some other shape. But equally, I also think there's going to be some surprise. In other words, I think some things are going to go up, as this volatility, chaos, and instability takes hold, right? I mean, because long-term interest rates jump by 0.5%, 1%, it will absolutely have an impact on all asset markets. Interest rates are critical to asset valuation, right? If you lift interest rates up, it is simply like gravity, right? Asset valuations should go down. Now, current stock markets, because they are basing it on the idea that short-term interest rates are kind of going to go back by a lot, there's that dissonance, there is that difference. But my view is that the bond market is going to have its way. They want higher rates for long term. And yeah, I mean, the governments of the world have no choice, right? I mean, they need the money, right? They're in debt, right? I don't really have a choice. When the US government, the way they fund themselves, so they have these bond auctions, right? So, they say, hey, we're going to sell $13 billion of 10-year debt or $15 billion of 30-year debt, and it's an auction. And in an auction, what happens? Well, people come and say, okay, I'm willing to buy, and and the buys are expressed in terms of interest rates. But if the auction cannot be, let's say, filled, with buyers at current rates, well, the interest rates just keep going up until the auction fills out, right? So I don't really know exactly how this happened, but nonetheless, I can see very clearly using common sense. I don't need any complicated logic to see who has the power here, right? It's not the government. It is the bond investors, right? They can say, hey, I don't want to pay, I don't want to buy your bond, US government, if you're only going to give me 4.95%. If enough investors say, I want 5.5%, that would be a shock to the system. That would be a stunner, right? And stock markets are not prepared for that. Most markets are not prepared for that. So that's like, putting all of this together to be like, bottom line, pay attention to the bond market, pay attention to the 30-year bond yield, stop listening to all these people. It's like, Powell, short-term interest rates are going to get cut. This is what matters. There's something much more complicated that is going on in the background, and it's not as simple as it used to be, as in the old bull market when, hey, low interest rates, stock price up, no more. At least that's my view. So what will go up in this period? Well, my view is that the critical thing that matters when, I suppose, if this happens, is going to be scarcity, right? And you can kind of see this. Okay, this is another very busy chart, and try and make this easy for you. So here, again, you can see the Liberation Day crash, if you will, right? Orange is Bitcoin, gold is gold color, right? Blue is Ethereum, gray is silver. I threw in Dogecoin here as well, but and I'll tell you why in a moment. Essentially, all of these represent better relative scarcity to the US dollar, or pretty much any government issued currency, right? I mean, and what you can see is post the Liberation Day crash, scarcity assets have just rocketed higher. Gold, right? That's the gold colored line, up, right? Let's find Bitcoin. Bitcoin is the orange colored line, up. Silver, up. Ethereum, that was pretty much the Ethereum bottom, up a lot, right? XRP, I know many people would not consider that a scarce asset. I'll tell you why I think it is one. Also up a lot. Dogecoin, starting to get going, right? What are people doing here, right? So my view is this, which is that people are seeking out scarce finite assets. Everyone knows the case for gold and silver, so I'm not going to, put that up there. You can go to Grok, you can go to, ChatGPT, and it'll tell you the inflation rate. But being that the central concern of the bond market is inflation, right? And it is telling us very clearly that they do not believe that long-term inflation is under control. They are nervous and edgy about where current bond rates are given that information. Well, I mean, the investors, sophisticated big money investors are searching out things that are scarce and finite. Obviously gold, obviously silver, and you can see that behavior. Central banks around the world are buying up gold, and as a result, gold is up like this, right? Bitcoin has an inflation rate of 0.83%. I mean, and that rate is going to keep going down and keep going down. So very naturally, people are starting to push money into Bitcoin. We have something free to offer you today, which is our exclusive Bitcoin Trigger Report, and is packed with really insights like the ones that I've been telling you about in this video. Click on the link above and you will have exclusive free access to our Bitcoin Trigger Report. Now, most people don't, think about Ethereum as having inflation rate, but their inflation rate is near zero, given that they have been burning, essentially destroying Ethereum to reduce its supply. So it's a scarce and finite asset. And as a result, people are buying it. XRP, which, some people will think is like a joke to put it on here, but they too have a very low inflation rate. So no real shock that people are going for it. And Dogecoin, which is, again, like some people treat it as a joke. I actually view this, as something that there's enough people that have enough gains with Doge, It's a currency that, you wouldn't choose to store your value in it, but as a medium of exchange, sure. I mean, and I know what people be like, Paul, these are not real currencies. These are all just made up things, made up coins. You know what? Market doesn't care. People are assigning value to Bitcoin. People are assigning value to Ethereum. People are assigning value to XRP. People are assigning value to Dogecoin. Yeah, they are saying these things have value, and their value is based on their scarcity and finiteness, which is trackable, which is monitorable, which is known, which is not true for the sovereign currencies. Nobody really knows how much US dollars in circulation, right? Nobody knows how many have ever been issued. And nobody really knows what the policies are. I mean, the Federal Reserve can cut interest rates and then be buying bonds, thereby issuing currency. In other words, there is no transparency to the US dollar or any of the sovereign currencies. And say what you will about cryptocurrencies, you can go on the blockchain and know exactly how many Bitcoin exist. And that's there, and it's in public. Same for Ethereum. Same for XRP and Dogecoin. So the blockchain is this very transparent way to know demand and supply of what is going on. And then if you are a sophisticated user of crypto, you can see the interest rates associated with borrowing and lending any of these currencies. There are interest rates, and they are affected by their inflation rates. They're also affected, obviously, by what is going on in the traditional finance world, TradFi, as the crypto folks call it. But bottom line, my view is that through this period, we are going to see some rocket ships out of these cryptocurrencies. I do not believe that most people get the connection between what is happening in the bond market, interest rates, inflation, to Bitcoin and Ethereum and XRP. And in the scenario that I think has, I'll say, better than 50-50 shot of happening, which is that for whatever reason, something happens. I mean, it's always something that very few people can specifically tell you, but something happened, an exogenous shock, as they call it, that few were expecting. Federal Reserve will go to cut because they'll worry about financial markets locking up, some recession, unemployment spiking. In other words, they're like, yeah, I'll let inflation blow. We'll worry about inflation later. We got to take care of, the markets now, or maybe an auction goes badly. Who knows what it is? Short-term rates go down, long-term yields go up, inflation expectations jump. These will be rocket ships. That's my view. That's my view. You can agree or disagree. Now, one last mention of something that I get a lot of questions on, which is that in the scenario, of long-term yields blowing out, right? I think that's the scenario in which Fannie Mae and Freddie Mac get set free. And the reason for that is that, the Federal Reserve is the one that has been manipulating, managing mortgage yields pretty much. Let me put this up again. I put up this X post, has been managing and manipulating mortgage yields for, pretty much since 2008. And starting about 2021, 2022, as you'll see here, in this part of the chart, it stopped doing that. And in the scenario that I'm talking, which is long-term yields blow out, cause chaos, instability, whatever word you want to use, have a correction, whatever, the government's going to need Fannie Mae and Freddie Mac to go back to doing what they used to do pre-conservatorship, which is that they used to manage the mortgage rates. So in the scenario that I'm talking about, that will be, I believe, the trigger point, if you will, for Fannie Mae and Freddie Mac to go out. And this is telling you. So the green line here is of a Fannie Mae junior preferred. If you don't know what the junior preferred is, check out some of my old videos. But this junior preferred, which is the FNMAS, is now trading for what? I mean, at a price that is equivalent to something that was well before conservatorship, right? I mean, it's at June prices, right? I mean, so the folks buying it believe that this is imminent. This is going to happen. There's no way you'd pay, $14, $15 for a 25 par preferred unless you really thought that this was a better than 50-50 shot, right? And I have no idea what people are thinking, but my view is that the interest rate setup would really be the catalyst, if you will, the sort of like the push to move this over the line finally, because in 2008 that was the issue, right? I mean, Fannie Mae and Freddie Mac had borrowed so much money, they had put so much money into mortgage-backed bonds. The value of those mortgage-backed bonds had crashed, which then people said, well, oh, they don't have enough capital, so that's what drove the whole conservatorship. In some ways, this would be a reversal of what happened. And in that scenario, then, the blue line is Fannie Mae stock. Yeah, he would jump. I mean, the scale of this is like where I think, I don't know what 2 and 3 are. Let's see. Did I get this wrong? No. The scale of this is, yeah, okay. The right-hand side is the preferred and the left-hand side is Fannie Mae stock. So my view is that, it would then shoot back to something like here. Arguably, it could go back to here. However, there are complications related to the government's position on its senior preferred. And so the conditions under which they release might limit that, at least temporarily. We don't know all the answers because the event hasn't happened. And the event will have information that will be material to what happens to the common. But in all likelihood, the event will have less impact on the preferreds. And the pricing is telling us that. Because the preferreds are capped out, right? I mean, they have par values of $25 or $50. Now, interest rates are back to where they were in 2006 and 2007. In other words, if Fannie Mae, wanted to raise capital, interest rates are kind of like where they were pre-crisis, more or less. So in some kind of like, I don't know, karmic way, everything's coming full circle. And Fannie Mae and Freddie Mac, could get released in the chaos and instability and trouble, that will come. I do want to make this clear. I'm not expecting a crash. I do expect something that, would be like a correction. It might be, sector by sector, taken to the woodshed and cut, by 20, 30%. Stocks, maybe one by one. I mean, it will obviously have an impact on the S&P 500 and all the, because, the popular stocks, those are the ones that people own. So, I mean, and those are 30, 40% of the S&P 500 and NASDAQ 100. So they'll get hit. But I don't think this is looking like 2008. So what should you do? I don't really know. You're going to have to look at your risk level, how much money you have, how much wealth you have, your income, your age, how close to retirement you are, how seriously you take anything that, you see on a YouTube channel, and determine what you have to do. All right. That is a very comprehensive Investment Tuesday. I hope you liked it. Join YouTube channel and get early access to this video. And then come back next week. This is Paul saying thank you and